In this edition of our Strategy Blueprint series, we're looking at how swing traders can use one of the most powerful features available inside Seasonax, and that is event seasonality. You can see event seasonality here. Now, most traders think of economic releases as day trading events. They might think about the immediate reaction to, inflation prints, non farm payroll, employment reports, central bank decisions. You've also got GDP releases. But some of the biggest opportunities don't occur necessarily in the first 5 minutes after the release. Sometimes the best opportunities occur in the days and weeks that follow. And that's where the swing trader comes in. So let's start with the basic idea before we get into the detail. So economic surprises matter for swing traders because markets move when expectations change. It could be a central bank decision, an inflation report, or employment release that dramatically alters market expectations for interest rates, economic growth, inflation, corporate earnings, risk appetite. And when that happens, markets often begin a repricing process. And those repricing moves can last much longer than the initial reaction. For swing traders, that creates opportunity. Now, the challenge is knowing, which events tend to create lasting trends and which simply create short-term volatility. Now, there isn't a quick answer to this, and I've spent a lot of my career trading macro events, and I've managed to get it down to a 3-step process for people to follow. Now, obviously, the full knowledge of understanding how to do this takes considerable time and effort. However, this is the basic process that people are looking for swing trading out of a macro event. So first of all, you need to see what the baseline, what's expected. So in other words, if inflation is expected to come in at 2% for a particular release, and then instead of coming in at 2% year on year, it comes in at 2.9%, well above the market expectations, well above all economic projections, then that will be a big surprise. And because it's a surprise, you'll get a reaction. But then just because you have a data point that comes in as a surprise, it doesn't necessarily mean you're going to get a strong reaction. Because what you'll find is sometimes the market's focused on inflation, sometimes it's focusing on jobs. It all depends what the central bank is focusing on. And then you've got to ask yourself, does this change the bigger picture? And for a swing trader, what they're looking for, a baseline that's expected, a surprise that changes the bigger picture. And when you get a surprise that changes the bigger picture, that's where you tend to have a swing trading opportunity. So that's the basic 3-step analysis approach. What's the baseline? What's the surprise? And for a swing trade, it needs to have changed the bigger picture. So in other words, that inflation data has meant that the central bank is likely to embark on a series of interest rate hikes over the next 3 to 6 months. Or that strong jobs report means that the central bank can stay at their current level of interest rates longer than markets were expecting. Or that GDP print is a really big surprise. And it's those opportunities that the swing trader who trades macro events is looking for. And now, right, when you understand that, this is then where Seasonax's event feature becomes extremely valuable. Because instead of focusing on a single event, you can analyze how markets have historically behaved across many occurrences of the same event. You can look at central bank decisions here, right? See how the euro dollar's behaved over all these different meetings, over the Fed meeting, over the ECB meeting, whether the Fed's cut, over the Fed minutes. It could be a Bank of England decision. You can look at the pound. It could be a US CPI release. You can come down here. You can see, okay, CPI, Non Farm Payroll release. And Seasonax allows you to study the impact of all these events that are listed here. And when you have an event, and for this situation, let's look at a non-farm payroll report for the euro dollar. Okay, this is over the last 10 years, and this is a 10-day reaction. And what you can do is you look here on the day of the event, you can see on the actual release, you can quickly see average moves, right? Winning percentage, maximum gains, maximum losses, and typical post-event paths. Now for swing traders, what the swing traders can do is they can see, well, what is the typical path in the 9 days after a really strong report. Now, not every event will create a lasting move. Obviously, some events produce an immediate spike that fades within hours. Others, though, create a repricing process that can continue for days or even weeks. And the goal of the swing trader is not simply to trade the reaction, it's to identify opportunities where the market has historically shown follow through. And this is what helps separate tradable trends from short-term noise. So let me show you an example here. So let's look here, the first 5 days after an NFP report. You see, on occasions, you've had a maximum gain of 3.70% and a maximum fall of 2.53%. So straight away, you can see there are occasions when you get these strong moves. And in the last sort of 3-4 years, the maximum gains has been 1, 2, 3, 4 times, where the maximum move has been 2% out of a non-farm payroll decision. And you can see the maximum rise here, right? This gives you a decent indication of what the maximum amount that the instrument has moved. And if you look over 9 days, you can see, okay, look, there's been times when it's been almost as high as 4% to the upside and nearly 4.60% to the downside. So swing traders will often struggle with knowing, when do we take profits, whether a move has more room to run, or whether they're being overly ambitious, right? And what Seasonax does, it helps you to analyze those average post-event returns, the maximum historical moves, the typical ranges, so you can start to set your expectations based on recent data over the same event. So this allows traders to set targets that are based on historical evidence rather than trade emotion. So it's incredibly helpful. Also, you can use Seasonax to help you calibrate your stop loss. So major economic releases naturally create volatility, but how much volatility is normal? So using historical event data, traders can analyze the typical adverse excursion. So you can see here, let's look at one of these years that there's been a gain, right? So let's look, non-farm payroll. Here, you've had the pattern. If you look here, you can see this is the profit as a percent, right? And you can see, okay, here's a profit of a percent. But look, the adverse excursion was only minus 0.08%. So it only went minus 0.08% against you on the trade when it was profitable. Here, 1.20%, it barely went anywhere against the move. Here, 1.02%, there was no adverse excursion the other way, right? So in other words, during the time of that pattern, there was no point at which there was a negative return. But if you look at this 3.70%, this positive return, that there was a time in the pattern when there was a negative return of 0.47%. So straight away, you can just see, look, from 2025 to 2026, look, the maximum adverse excursion when the pattern was profitable was really quite limited. So if you've got a strong reason for the instrument moving in a certain direction, you can straight away see, okay, I don't need to set my stop very far into that adverse excursion territory. Extremely useful. And now the strongest setups occur, right, when event seasonality will align with technical structure. So you might have a key support level, a breakout pattern, a major trend line, or a momentum signal. So I'll give you an example of a trade that I recently took in the euro dollar, just to give you an indication of what you can do. So here was the non-farm payroll print. I'm just going to take it over to the US data alone, right? I was looking at the data and I knew that in this context, a strong jobs report would mean that the Federal Reserve will be more likely to move to interest rate hikes. And that was a pivotal kind of turning point. We'd had a strong ADP jobs number. We had strong job openings. This is the jobs report for June 2026, right? And the prior was revised higher. So I knew immediately, as soon as I got that, that's dollar strength. And I was showing clients, this is dollar strength, yada, yada, yada. And these are the opportunities. You could look at the euro dollar. And we were taking it as it went down through this support level, that support level. But now that it has changed the picture a little bit. Now we've got another CPI report coming in. But I was able to say, look, for a potential swing trade, a perfect entry would be on this time price opportunity, that value area low here. So saying to clients, look, this is the area, and in this case, it was for intraday trading. It could turn out to be a swing trade, depending on the US CPI report on Wednesday. But that technical area was a great area to look for potential sellers and a bounce off that zone, the value area low. So that's just one example of using events in my personal trading for a potential swing trade. Now, seasonality doesn't replace technical analysis. It complements technical analysis, and it can strengthen it by adding historical context. So if you are a technical trader, you can use Seasonax to complement your technical analysis, or you can just use the Seasonax data and use the historical moves and the adverse excursions to help set stops. It's kind of up to you how you use the data, but the benefit you've got is you've got the actual historical evidence of what's happened on previous reports. So the key takeaway for swing traders is simple. Economic releases are not just short-term trading events. They're often the catalysts for longer market repricing moves. And using Seasonax's event feature allows you to identify those higher probability opportunities. You can set realistic targets, improve stop placements, and better understand post-event behavior. So for this non-farm payroll report that I took, one of the most helpful things is you can see that the euro dollar, the maximum fall was about 1.27% in 2022, 2023. And you can see when you're heading towards about 1% for the actual day release, you can see that was a reasonable target to achieve. About 0.75, 0.80% fall would be very reasonable. And you can see here, right, when you look at the actual day of the release, and when we want to assess what the drop was, look, do you see how the fall on that day there was about 0.80%, pretty much perfect. And you see that way, by using, just at a quick glance, you can see, okay, the moment I hit about 0.75, 0.80%, that's a reasonable place to take target on that instrument. How useful and helpful is that? So no more guesswork. You can use the economic data. So that's where seasonality can provide a real edge in your trading.